So hi, everyone. Welcome. This webinar is hosted by the Oregon Farmers Markets Association, or OFMA. We support farmers markets with training, networking, advocacy, funding, and promotion. We run workshops and peer learning circles every month, and you can check out our events schedule online. And we have recordings of past workshops in our YouTube library. We'll drop some links in the chat to those. Really happy to see this crowd gathering here. Thank you for all your introductions. My name's Amanda Cross. I'm with OFMA and hosting today. Also here is Kendra Graves from OFMA, who you will be talking with in the chat. Before we dive in, let's talk about how to make the most of our time here together. First, cameras can be on and off, whatever works for you today. This is your space to learn together, and we've got lots of ways to contribute. When you have questions, raise your hand, or you can put them in the chat as you think of them. We'll tackle quick clarifications as we go and save longer questions for the Q&A time at the end. Make sure also to leave space for others to jump in. It's that balance of sharing your voice and making space for others, giving them a chance to answer or respond to you or get their own question in. That makes these workshops collaborative and a group effort. You can also use emojis and reactions to show how something landed for you. The quick reactions mean a lot to our speakers and let them know what's resonating with you. And now to introduce our speaker, Ari Rosner brings a really unique combination to this work. He's been doing nonprofit bookkeeping for years across Oregon, but he's also spent over a decade as staff at the Hollywood Farmers Market, which has one of the state's oldest SNAP programs. So he gets both sides, both the accounting principles and the on-the-ground reality of SNAP tokens, double up food bucks coupons, and all those details that make farmers market bookkeeping its own special challenge. Today he's going to walk us through using bookkeeping software to keep your records accurate and your food assistance programs running smoothly. Welcome, Ari. Thanks for being here.
Yeah, thank you for having me. And thanks everybody for coming here and to hear about maybe not the most exciting topic that OFMA puts on webinars about, but I think a really important one, especially given the growth of these incentive programs over the last several years. They can be sometimes a large part of the financial activity of farmers markets. And so I think it's really important for markets to have the tools to account for those in right ways. So what we're going to talk about today is best practices in accounting for SNAP tokens, right? And double up food bucks incentives currency. So we'll talk about the accounts that you are going to want to have in your chart of accounts to track all of the transactions involved. We're going to look at examples of some transactions that farmers markets have to be booking that are part of the cycle of the program with SNAP and double up food bucks and how to book them. And then hopefully also kind of a general understanding of why we book this activity in this way, just because I think, it's one thing to learn certain rules about how to book certain transactions, but I feel like it always kind of sticks better and also people can use the financials better as well, if we understand why we're doing things in the way that we are. So yeah, that's what we're going to be talking about. A few assumptions just to start out, just because I know there's a lot of diversity among farmers market organizations in terms of their scale and their practices. And so I'll just say that the information that I'll be giving out in this presentation is going to be most useful if obviously you're an Oregon farmers market and you process SNAP and or double up food bucks. Use accounting software, which it sounds like, just looking from the chat, that most folks are using QuickBooks. Everything that I'm going to be talking about, no matter what accounting software you work, it will apply to you. So I won't be talking specifically about this is how you do it in QuickBooks, but it'll apply to whatever software you're using. And then the third is that you use accrual basis accounting rather than cash basis. So this is just two different types of accounting. In cash basis accounting, revenue and expenses are booked based on when cash moves. I mean, either spending cash or receiving cash. That's when you book revenue and expenses. Whereas accrual basis accounting uses kind of a more nuanced approach that reflects the actual meaning of those financial transactions. In particular, accrual-based accounting, you recognize liabilities, which you wouldn't have in cash basis accounting. So we don't need to go into detail, I think, in those, but just to say, I don't typically recommend cash basis accounting for organizations of any real significant level of complexity. And I especially wouldn't recommend it for a farmer's market processing SNAP or double food bucks, just because, as we'll see as we go through this, there are real liabilities associated with running those programs that you do want to really see reflected to get a full picture of what your financial position is. So, that's just to say that, what I'll be going through will be how you book these transactions in accrual basis. Okie doke. And then one last quick thing before we really get started, just because I know there's probably different levels of, financial fluency or experience. Just want to give a few quick definitions for like some of the terms that we'll be using as we go through this. So on the left, we have terms that relate to your financial position, which is you have assets, that's what you own. So, cash and bank accounts, accounts receivable, maybe equipment or other fixed assets, but things that you own. And you have liabilities, that's what you owe, bills that haven't been paid yet, payables, other obligations. We'll be talking about some liabilities related to SNAP and incentives programs. Your equity, or sometimes what's called net assets, is just your assets minus your liabilities. And these three things are conventionally shown on a balance sheet, which is sometimes called statement of position. Same thing. That's just a financial report that shows those three things in whatever level of detail, sub-accounts for a given date. And then on the right, these terms may be a little more intuitive to understand. Revenue is what you earn from operating your organization before any expenses. So when I say revenue, I'm talking about gross revenue, not including expenses. Expenses, what you spend on costs. And then your revenue minus your expenses are your net income. And those things are shown on a financial report, which is commonly called a profit and loss, or P&L, sometimes an income statement. And that's just a financial report over a given time period that shows your revenue and your expenses. So just a few quick definitions, just to make sure we're kind of relatively on the same page. Okay. So some of the accounts that you will want to have in your chart of accounts to capture the activity that's flowing through the market for SNAP and double food bucks. These are the accounts. So I'm not going to define them here. So I think we're going to send out these slides, I think, later. So this slide is just in here to kind of have a handy place to really just see all of these. I'm going to define them kind of one at a time as we go through the transactions. And then also, I should just say, I'm giving them names here that I think are relatively descriptive, but obviously if you have your own chart of accounts and you already have these and they're named something else, obviously that's fine. So you'll need something that's like all of these accounts, even if it doesn't have this exact name. All right, and then one other thing I guess I didn't mention earlier, but we will have time at the end for questions, but also as we get into the actual, the transactions and these accounts, I'm gonna pause kind of periodically for questions, and also just feel free if you have questions at any point as we go through the transactions, just ask them, because, I think it's always better to, if we're going through steps 1, 2, 3, and you maybe had a question on step 1, but you didn't ask it then, it maybe makes it harder to stay with things on steps 2 or 3 or whatever. So I think it's good. Like I said, I'll be pausing for questions, but as you have questions that relate to what I'm talking about, feel free to just to let me know. Yeah. All right. So the transactions that we are going to be going over are ones that I think are probably pretty universal to all Oregon farmers markets that participate in these programs. You receive funds from Farmers Market Fund for incentives. You process SNAP benefits, right? So you receive funds for that. You pay out reimbursements to vendors as they, collect tokens and double up food bucks that shoppers spend with them. And then at the end of the year, all markets that participate in double up food bucks do a year-end reconciliation with Farmers Market Fund, and that typically results in a transaction also, in a payment either from Farmers Market Fund or to Farmers Market Fund to kind of close out the year. So I think these are transactions, like I said, I think are probably pretty universal for all farmers markets participating. It's possible that some of you may have other transactions involved, and maybe we can talk about that if you have questions about those at the end, because maybe I can help with those as well. But we're going to kind of go through these transactions kind of chronologically, sort of following the seasonal cycle of the double up program. And I'm getting over a cold, so apologies if my voice gets gravelly at times. I'm gonna keep drinking tea throughout, and I think we'll get through this. All right. So transaction number one, kind of what starts out, the double up food bucks season each year, is that markets receive a payment from Farmers Market Fund to fund their double up food bucks incentives for the season. Sometimes it's one payment upfront. Sometimes it's, I think maybe more often, it's a few installments throughout the year. So in this example that we're using, you, the farmers market, receive a $10,000 payment from Farmers Market Fund for your double up food bucks incentives for the season. At the time we receive this represents a liability. So the liability in this case is that you now have the obligation to spend those funds following the conditions of the award. So it's what we call a conditional grant, right? It's a grant that has certain conditions that must be met. If they aren't met, then the funds are returned to the grantor, which is kind of also how double up food bucks works, right? At the end of the year, there's that reconciliation and the funds are returned. So it's not revenue at the time it's received, because the conditions still have to be met before the revenue can be recognized. So it's what we call deferred revenue. Sometimes you see it called unearned revenue, same thing. So if you see unearned revenue, deferred revenue, they mean the same thing. But it's a liability that is expected to become revenue, but has not yet been earned because those conditions haven't been met yet. So when you receive that, in this case, $10,000 installment payment, the full $10,000 gets booked to the liability account, which I'm calling double up food bucks deferred revenue. One other actually note on double up food bucks. Throughout here, I'm kind of just talking about double up food bucks. I do know some farmers markets also participate in a program called Produce Match, also through Farmers Market Fund, which is, it uses a separate currency, but operates very similarly to double up food bucks. Whenever I say double up, if you do also distribute Produce Match, whenever I say double up food bucks in this presentation, you can just kind of read that as saying double up food bucks / Produce Match. The accounting treatment of those two programs is the same, and you can just book all the activity basically in parallel to the same accounts. And I see a question in the chat. Well, accounts receivable is an asset account. So
can we read the question?
Oh, yeah, sorry. Yes, I see. Yes. The question from Carrie is it correct to make this income an accounts receivable account and release these funds as they're dispersed? We are going to be releasing the funds as they're dispersed, but we'll be releasing them from the liability account. This payment received from Farmers Market Fund, it might flow through a receivable account, like, if, you get your contract that says, okay, you'll be getting a $10,000 payment, you could book that as a receivable, but instead of the receivable would be just, it would flow through that until it gets to cash. But ultimately, once you've received the funds, you have $10,000 in cash, you need to also be reflecting a $10,000 liability. So yeah, you don't want those funds to be hanging out in a receivable account and released from there. I don't know if that explanation makes sense, but like my answer would be no. Yeah. Any other questions on example transaction number 1? All right, example transaction 2 is kind of an analogous situation, but for SNAP funds flowing, into your market's bank account. So in this case, you've processed SNAP benefits on a market day, and you receive a deposit from your payment processor for those SNAP tokens that were distributed. In this case, using example $2,145 a deposit. It's usually some not round number, Actually, one other note to say on when I talk about SNAP tokens in general, I know some farmers markets also process, for instance, like credit cards or debit cards and distribute cash tokens for those. Kind of similar to what I said for produce match. Whenever I talk about SNAP tokens, you can take that to mean that also can include other tokens you're processing. As it's basically the same accounting treatment. You're running people's cards, you're getting cash in your bank account, and you're recognizing a liability. So this deposit does represent a liability when you receive those SNAP funds or any, funds from selling tokens. You have an obligation now that you will reimburse vendors as those tokens get spent at the farmers market at their booths. So that liability, I'm calling it tokens payable. You could call it vendor tokens payable, but it represents something you owe to your vendors that at some point in the future, you will have to pay them those funds in cash. So when you receive that deposit, you book that full amount to what I'm calling tokens payable, which is a liability account. And one note on this, different payment processors, I think, treat this different ways, but your payment processor, obviously, they're charging fees for those payments. I think sometimes those fees are charged in separate transactions. Sometimes those fees may be taken out of the deposit. So you just want to make sure that you account for that if it's that latter case. So if, for instance, in this example, you've sold $2,145 in tokens, but the deposit you receive is less than that because fees have been taken out. So when you book that deposit in your accounting software, you want to make sure you split it, right? You want to make sure you book, in this case, $2,145 to tokens payable, and then a negative $66.64 to merchant service fees. That way you recognize the expense of those merchant service fees or whatever card processing fees, bank and merchant fees. But you're still reflecting the full amount as tokens payable. The key thing is you always want the amount that's going into tokens payable to the amount that was distributed in tokens. Any questions on this example number 2? And you can, if you have questions, like you can put them in the chat, or I'm fine with someone speaking up. I'm okay, even if you interrupt me, I won't be mad. Okay, but if there are no questions, we can move on to number 3, and they will get a little more complicated as we go. All right, transaction 3 is a token or double up food bucks reimbursement paid to one of your market vendors. So You may pay vendors by check, you may pay them by electronic deposit, it doesn't really matter in terms of how to book it. But in this example, we have a vendor who has turned in a reimbursement request that is some SNAP tokens and some Double Up Food Bucks. So in this case, we're saying $45 in SNAP tokens, $22 in Double Up Food Bucks. So it's two different things are happening, right, in this transaction, and you're going to end up splitting this when you book it so that you can treat them both separately. First, you have the SNAP tokens, and that's pretty straightforward. It comes right out of that token payable liability. So that portion reduces liability, and the portion that's for Double Up Food Bucks is an expense. So Double Up Food Bucks incentives paid out by your farmer's market are an expense. They're a program expense for a program that the farmer's market is running. It's an expense that's funded by revenue, which we'll see as we get later on into these transactions. So you're booking it as two different things. In this case, you're splitting the expense. You book $45 tokens payable to cover the SNAP tokens that were turned in, and $22 to the expense account that I'm calling Double Up Food Bucks incentives paid. So as you book all of your token and Double Up Food Bucks reimbursement payments to market vendors, in that Double Up Food Bucks incentives paid expense account, that is where all the expense for Double Up Food Bucks incentives will accumulate, right? So if you look at a report for the full month, you'll see everything you spend in Double Up Food Bucks incentives paid for the month will be in that expense account. So yeah, any questions on this? This example is for obviously a vendor who's turning in both SNAP and Double Up Food Bucks, but obviously if it was just SNAP or just Double Up Food Bucks, then you would book it only, to one or the other of those two categories. But if it's both, you want to split that so that you kind of put both types of things in their proper place. So yeah, any questions on that while I pour my tea? Okay, moving on. So example 4 is where they start to get a little more complicated. This one is going to be a monthly journal entry, because kind of some of you may even have noticed there's kind of been a part missing so far, which is in example 1, we put all of the Double Up Food Bucks funds from Farmers Market Fund in a bucket, what we call Double Up Food Bucks deferred revenue, and we would not recognize that revenue until the conditions have been met. But now we've gotten into the market season, we've reimbursed vendors for tokens. Those conditions now have been met, at least for a portion of your Double Up Food Bucks funds. So it is time now to recognize that Double Up Food Bucks grant revenue. So in this example, you've entered all token reimbursements for the month of September. So you always want to do this after you've already done step 3 for everything, for all the activity for that month. You run a P&L report, right? You run an income statement for the month, and you can see in that month, you had a certain amount of Double Up Food Bucks incentives paid. So all the payments you made to your vendors in that month added up. In this case, we're saying equal $1,566. That's the total amount of incentives that you paid out in the month. So the transaction you'll book in this case is a journal entry that reduces Double Up Food Bucks deferred revenue, reduces your liability, and it recognizes Double Up Food Bucks grant revenue, right? The revenue. This is when you're actually recognizing on your income statement the revenue from Farmers Market Fund. So you book this journal entry for, conventionally for the last day of the month, given that you're making it for a month. Debit is just what we call the left-hand side of a journal entry, and credit is what we call the right-hand side of the journal entry. They don't actually really mean anything beyond that. But in this case, you want Double Up deferred revenue on the left side, debit $1,566. And Double Up Food Bucks grant revenue on the credit side, $1,566. One thing you might have noticed that this means that Double Up Food Bucks grant revenue for the month will be the exact same as the expense for the month. Therefore, on your income statement for that month, it'll have zero impact on your net income, which is correct because it's a program that is being fully funded by grant funding. One other note I just want to make on this. So I'm saying this as a monthly journal entry. That's sort of under the assumption that most farmers markets are at least looking at like their financial reports every month, but that may not be the case necessarily for your farmers market. Like for instance, maybe if you only run financial reports quarterly and you really don't care about or look at them in those kind of middle months of the quarter, then this could be a quarterly journal entry, right? And in that case, you would look at, for instance, like you look at a monthly P&L or you look at a quarterly P&L, right? For, let's say, July 1st to September 30th, you'd see all the Double Up Food Bucks incentives expense for that quarterly period. And then again, you would book, in this case, a quarterly journal entry for the end of that quarter. So you basically want to do it at the same frequency as you are running financial reports, because any financial reports for a period where you have not yet made this journal entry are going to be potentially misleading. I mean, they'll be missing a piece. Any questions on this journal entry? Okay. All right, so we'll move on to example transaction number 5. So at this point, you basically run your program for the full season. You booked all of the activity, payments received from farmers market funds, SNAP revenue, SNAP funds received, and the Double Up Food Bucks expenses and offsetting revenue. And at the end of the season, each farmers market participates in a year-end or season-end reconciliation of their program activity with farmers market fund, which basically looks at all the payments that the farmers market received from FMF, all the incentives that they paid out, and usually there's some kind of a transaction to kind of close things out. Like if the market received a certain amount and they spent a little bit less, they pay that amount back to farmers market fund, or if it's the other way around, farmers market fund sends an additional amount to close it out. So in this example transaction, you've entered all of the activity in steps 1 through 4, in examples 1 through 4 that we've talked about. You complete the reconciliation and receive a reconciliation statement from FMF that says $574 should be returned to FMF. So one thing to understand is that, so the end result of this reconciliation should be that Double Up Food Bucks deferred revenue goes to 0, right? Because once this reconciliation has been complete, there's no funds being held for the purposes of Double Up Food Bucks. There's no liability remaining. One note, I know that for some markets, rather than there being a payment that closes out the reconciliation, the funds are kind of rolled over and just added into the contract for the following year, or I guess subtracted from the contract for the following year. So, if that is the case in your reconciliation, then you're basically done. There's no need to make an entry for the reconciliation. Your deferred, whatever balance you have left in deferred revenue, just kind of rolls into the next year. But if that is not the case, then you need to book the reconciliation because there's a real transaction happening, right? You're, in this case, sending funds to farmers market fund. So, and how to book it, there's kind of 2 different scenarios that might be happening that would affect how you book that reconciliation payment. So one is that you look at your balance sheet for year end, and it shows 574 is the year end balance. So your accounting matches exactly with farmers market funds. They show the same total payments that have been made out in Double Up Food Bucks, and they show the same payments made from them to you, the farmers market. So in that case, simple, you book that $574 payment to Double Up Food Bucks deferred revenue, and it reduces it to 0. The second scenario is that your balance sheet shows a different year-end balance, and this would probably just be due to there being minor accounting errors during the year, which can easily happen with a large number of transactions going on throughout the year. So let's say in this example, the Double Up Food Bucks deferred revenue balance shows 556. So it's a little off. It's off by what, $18. In this case, you split the reconciliation payment. You book 556 to Double Up Food Bucks deferred revenue. So you still close that account down to 0. And then the remaining amount you book to Double Up Food Bucks incentives paid, or potentially book to, miscellaneous expense or something like that. The main thing to keep in mind is that the goal is for Double Up Food Bucks deferred revenue on your balance sheet to end up at 0, right? So whatever the balance in there, you close that out. And then if there's additional expense, you recognize that. And I see Mallory just put in the chat, if you are in scenario 2 and you don't know why, or you think it's possible that Farmers Market Fund has made a mistake, please reach out to them. And yes, I would definitely agree that, yeah, if you're in that situation and you have the capacity to investigate or to reach out to FMF, you should do that. And also, if you've been accounting for it in this way, you do have a handy way of just looking at all the activity in this Double Up Food Bucks deferred revenue account. You see the payments coming in from Farmers Market Fund, you see the payments going out to vendors. It can maybe make it easier to see where the mistake might have been, right? Because you've got all that activity in one place. So yeah. Thanks, Mallory, for that comment. Yeah, any questions on Double Up Food Bucks reconciliation? Okie doke. All right. So, big takeaways from this are so at year end, basically this is what you will see on your financial statements from accounting for the SNAP and Double Up Food Bucks activity in this way. So on your balance sheet, you'll have some dollar value for tokens payable, and that will reflect the kind of cumulative value of all SNAP tokens that were distributed at your market but have not yet been redeemed by vendors as of the year end. So that's a liability that typically you also want to be covering with cash. So you want to, if your liability is $10,000 for tokens payable, you kind of want to be holding enough cash in the bank to cover that liability, because those are funds that you at one point at least received from processing SNAP and other cards. Also on the balance sheet, you'll have Double Up Food Bucks deferred revenue, which should be $0 at year end if you have completed your Double Up Food Bucks reconciliation with Farmers Market Fund. So whereas tokens payable, there's an ongoing liability that kind of persists over years. Double Up Food Bucks liability, deferred revenue liability, closes out each year. There's no, farmers markets don't incur any liability that goes on for future years. Partly that's because Double Up Food Bucks expire every year. They're printed with a date. And also it's because, Double Up Food Bucks aren't a liability that's tied to your particular farmers market. They're a statewide program that ultimately Farmers Market Fund is, responsible for. So you have 0 liability for Double Up Food Bucks revenue. And then when you look at your income statement, you will see Double Up Food Bucks grant revenue and Double Up Food Bucks incentive paid should have ideally the same, they should be equal, right? They should be the amount, they should reflect the total amount that you spent on the Double Up Food Bucks incentives. And therefore, they, in terms of your net income, cancel each other out. The revenue equals the expense, and so they don't impact your farmers market's income statement. They might not be, like we talked about in the last slide, if there was a discrepancy in the reconciliation, they might not be exactly equal, but they should ideally be equal. So yeah, I guess this would be kind of like, I think when you're looking at maybe when you look at how you currently account for SNAP and for Double Up Food Bucks, you know, I wouldn't make the claim that these processes that I've gone through are the only proper way, you know, to book individual transactions, because you know, there's multiple ways you can book transactions and still get to this point on your financials that we see, you know, that we just talked about on this slide. So I think if you, this is to say that if you are accounting for transactions differently than I've been talking about, but you still end up with the same, with this situation on your financial statements, right? Double Up Food Bucks revenue equals Double Up Food Bucks expense, tokens payable equals your unredeemed tokens, Double Up Food Bucks, no liability at year end. If you still end up in that same place, then you probably have a reasonably robust way of accounting for these programs. If you don't, if you're seeing different things on your balance sheet and your income statement, then you may want to make some changes to reflect the activity kind of more consistently. Okay, and I see Lacey is asking a question about cash basis accounting. Yes, not a lot of this is applicable to cash basis accounting because cash basis accounting just follows the movement of cash in and out, which is not going to necessarily be tied to when in accrual basis, when we actually recognize revenue and expense. So it's probably a longer answer to that than we would be able to do in this webinar. But yeah, Lacey, maybe we can talk about that at some point in the future. Because yeah, I mean, you might be looking at changing your accounting basis if you want to reflect this token and Double Up Food Bucks activity in a more meaningful way. It's a good question. Yeah. The previous treasurer wanted to change your accrual. Yeah, I mean, you may just have to bite the bullet and make the change to accrual basis. And you know, obviously, it means a lot of changes in what people are used to seeing on the financial statements. But overall, like I said, I think earlier, especially if you're processing SNAP and Double Up Food Bucks, you know, there are real liabilities associated with those programs. And if you don't have those reflected on your balance sheet, it potentially, you know, you're not having a full picture of what your finances really are. Which is kind of what the next slide. Oh, but there's another question. Can you explain a little more why, when we're reimbursing the vendor, we can't just book it under Double Up Food Bucks deferred revenue instead of adding Double Up Food Bucks incentive paid? Well, so accounting for that way only, and like, for instance, not doing any additional journal entry, then you would not reflect any revenue and you would not reflect any expense related to the program. And I do know that some farmers markets do reflect Double Up Food Bucks and incentives programs in this way in their financials, right? They kind of pass everything through a balance sheet account and they don't recognize any revenue or any expense on their income statement for Double Up Food Bucks. This is not really accurate. The Double Up Food Bucks activity is real activity of your farmers market organization. The farmers market is receiving a grant to operate a program. It is spending money on a program and attributing grant revenue to that expense. So yeah, if you just book the vendor reimbursements under Double Up Food Bucks deferred revenue and then kind of call it a day at that, you won't really be reflecting all the activity that your farmers market, all the financial activity that your farmers market really is doing. So that's why we have the Double Up Food Bucks incentives paid expense account and the Double Up Food Bucks grant revenue account. So, question of, why is this important? If we've been going on well enough with our whatever system you have now, and I think the answer is just, because these incentives programs, can be like a pretty major part of farmers markets overall finances. If you're not accounting for them in a consistent way, it can be misleading, right? You can get the wrong picture of, what your financial activity has been or what your financial position is. So like a couple examples, like if Double Up Food Bucks and revenue and expense, if you're not booking them each month, again, assuming that you're looking at monthly financials, if you don't have those balancing entries, right, where the revenue and the expense are equal each month, then you can run that monthly, financials and see, net income that is maybe lower than it really was or higher than it really was, depending on what piece was missing. And then on the balance sheet, if you're not accurately recording the liability associated, with SNAP tokens that are out there unredeemed, and the Double Up Food Bucks grant funds that have not yet been earned, then that can give you a wrong picture of your net assets. It can make you think that potentially you have more net assets than you really do because your liabilities are not fully understood. And so, yeah, having those misunderstandings, it can just make it more difficult for you to use those financial statements to help, making decisions for the organization. Okay. So I did actually have one other little, so I put the sort of a temporary end here because I wasn't sure how much time we'd have, but it looks like we were thinking I would have another 10 minutes or so before we get into the bigger Q&A. So there's one topic that Amanda and I were talking about and thought might come up as a question, because I know markets I wonder about this, right? So one thing you might have noticed under this scheme, right, funds, the tokens payable account continues to kind of go up as there are additional unredeemed tokens out there. And one issue that some farmers markets have can be that it just increases steadily over time and doesn't decrease because every year a certain portion of market tokens are not spent. So if there is a reasonable expectation that a certain amount of tokens will just never be used, that amount can be recognized as revenue. It's called breakage. And so this is a legitimate source of revenue in accounting, where basically you determine an amount, you determine an estimate of an amount of token. It's usually used more for like gift cards, but it's sort of the closest analog to tokens. You determine that a certain proportion of it does not have a real significant possibility of being redeemed. Then you recognize that revenue. It's called breakage revenue. So dealing with this can be a big topic. So I'm not really, there's a lot, markets have different, I've seen markets have different methods of actually determining the amount to write off as breakage. And really, if it is a significant amount that you're dealing with, I would really recommend getting advice from a CPA. But talk about it kind of just in general terms. There's 2 steps. First step is to determine how much of the liability can be written off as breakage. And then 2 is how you book that entry to write it off. So basically the way you determine that amount is you look at the historical pattern of your token redemptions over time. So one method I've seen is that farmers markets adjust that liability, tokens payable, to just reflect the value of unredeemed tokens from the past X many years, 3 years or 5 years or whatever, and with the idea that whatever liability accrued prior to 5 years ago, that's unlikely to come back because of the length of time that's gone by. So like, and an example, your year-end balance of tokens payable at the end of 2025 is $8,400. And you look back 5 years and that liability was $2,200. So in this case, if you were using that method that I just mentioned, you would go, okay, well, so the liability from the past 5 years activity is 6,200, right? The difference between now and 5 years ago. And so the difference, that 2,200, that's the amount that you can recognize as breakage. So that's a method that I've seen. You can look at other methods, but just taking that number and kind of looking at then how you would book that write-off. Once you've determined that amount, you will typically you'd have a dedicated revenue account in your chart of accounts for that token breakage revenue. You could also book it to miscellaneous revenue, especially if it's a small amount. So you need a journal entry to reduce your liability of tokens payable and recognize the revenue from token breakage. And so using that example of $2,200 from the previous slide, you can book a journal entry where you debit tokens payable and credit token breakage revenue and kind of lower that liability of tokens payable to a more realistic understanding of what the liability really is. Any questions on token breakage? I'm a little curious how many markets have done this, or do this regularly, or have in the past done this, have recognized kind of write-off revenue from unredeemed tokens. Lacey is asking, would you do that every year? Yeah, I think once you had an understanding of the historical pattern and maybe even just like a written policy that describes what your method is for determining how the write-off is calculated, then yeah, I would say every year. Some like I don't know, like big companies that like have a lot of gift cards and stuff like that do it every month. Like that's actually very common in general. In GAAP accounting is like recognizing breakage revenue very frequently. But for farmers markets, since it's not like a major part of the market's operations, I think annually is fine.
What happens if you just keep leaving it there and never do the breakage? Why?
You can, yeah. I would say like, and it maybe depends on like how the scale of that liability within the scale of your overall financials, right? I mean, if it's like a tiny percentage of your overall assets and it's not causing any issues and nobody really minds it, then maybe you never recognize breakage. That's I think fine. If it becomes a large amount though, yeah, I think the thing would just be that it's potentially over-representing your true liabilities. And so it's more conservative, I guess you could say, right? Because it's, you're making decisions based on an understanding of your net assets that is, like conservative, that probably you have more net assets than your balance sheet shows that you do.
Yeah, thank you, Ari. Thank you for going through all those transactions. It made it feel much more simple in my mind what's going on. But what does everybody else think? What questions do you have? Is there anything that you saw or heard today that you're going to change with your own systems or bring back to your treasurer or bookkeeper to ask about? Lacey's saying it makes a lot of sense to me. I just can't implement it until we overhaul our entire accounting system. And maybe this is a good spot for me to let everyone know that for coming to this webinar, if you have longer questions or you need to talk about something like moving from cash to accrual basis bookkeeping, you can sign up for a 1 hour one-on-one session with Ari. You just need to email him to schedule that, have that happen sometime, yeah, before the end of the year would need to happen. And let's see, we can put Ari's email in the chat, and you're welcome to schedule that. Okay, I see some more questions in the chat.
Yeah, I see Jordana asks, would you suggest to use this template for other food equity programs as well, or potentially other types of grant and their usage? So yeah, good question. It would really depend on what on those programs, on, you know, like how those programs are structured. I mean, but yeah, basically, I mean, this, you know, what this sort of the set of processes does is it basically, you know, what I'm doing is just treating Double Up Food Bucks like any you know, grant funded program, right, where you have program expenses and you have grant revenue. So yeah, I think it's very likely applicable to other similar programs. And Mallory's saying, I think it would work really similarly for Little Lettuce and Buck-a-Bucks. So yeah, I mean, in particular, yeah, if you have other programs where you're getting other sources of funding that are for some other incentive program, then yeah, I think you would use a very similar accounting. You might separate out, you know, the account, like have a Double Up Food Bucks deferred revenue, and then separately maybe have Little Lettuce or Buck-a-Bucks deferred revenue, just so the farmers market fund, you know, activity is kind of segregated in its own account, just so makes it easier for reconciliation and stuff like that.
Yeah, thank you so much for answering that. I already do something similar where I separate, you know, my question was specifically for like Little Lettuce, Bucka, all of, you know, there's like 4 different programs that we have, SNAP, Double Up, Little Lettuce, Bucka, and I have it separated out now, but not, I don't exactly do everything that you mentioned here. So it was very, I'm glad I signed up for this because I had all these questions and you answered them really well, and I really appreciate that. So yeah, it was like, do I separate them all? Do I keep them all lumped in, you know, sort of this like food equity thing here, or would it be best to separate them? So thank you.
Yeah. And I think the question of, yeah, whether it's best to separate them, yeah, it kind of just depends on what makes sense, like what you want to see when you're looking at your financials, right? You know, is it going to help you to see them, you know, Double Up Food Bucks, Bucka-Bucks, you know, what I forgot the name of the Little Lettuce, see them all as separate, you know, like revenue streams and, you know, expenses. If that helps you, then yes, keep them separate, you know, and if that's not as useful, then yeah, maybe you kind of group them more into their own accounts.
Yeah, and then the second part of my question was, you know, like for other grants, you know, we received a climate resilience grant from OFMA, you know, should I do the same sort of accounting with that, with this template?
Not necessarily. I would, so one thing about I guess, yeah, real, so like they're under generally accepted accounting practices, there's 2 different types of what we call like restricted grants, right? There are conditional grants, which we've discussed, Double Up Food Bucks falls under, and those are grants where there are very specific restrictions or conditions on how it's spent. And also the grantor reserves a right of return for any funds that aren't spent under those conditions. And for those types of grants, you reflect them the way we have, shown as deferred revenue. And then restricted grants are basically, it's so hard to describe in regulating, and like sometimes it can be hard to tell which type of grant is. But a restricted grant is basically a grant that is not as strictly conditional, that it must be spent within certain guidelines or rules or whatever from the donor or the funder, but doesn't necessarily have the same expectation that funds will be paid back to the funder if they're not spent following to certain conditions. So most restricted grants are that second category. Restricted grants, I would say, based on my understanding of the climate resilient grants, they probably are that category. And so for those grants, those are revenue when they're received. So the full amount of the grant grant is recognized as revenue. And then you do a thing that is maybe more complicated than we have time for, but you book a restricted net asset for it and then release funds from that restricted net asset account until the grant is spent. So you still have something in your balance sheet that shows that those funds are not fully net assets of the organization, that they're net assets, but that have a restriction from the funder on them. So it's kind of like a simple, I don't know, that's like a very short description to what is like actually like kind of a complicated topic. But yeah, I would say the climate resilience grants probably you wouldn't be booking as a deferred revenue liability.
Okay, great. Thank you.
Sure.
In the chat, Charlie brings up something that I've had farmers markets ask me about whether it's best practice to open a second bank account specifically for SNAP funds. It sounds like that's really simplified things for the Klamath market, but is that best practice? Do you have to set up a second bank account? What do you think about that?
I know some markets do. In fact, the farmers market that as Amanda mentioned, worked at for 10 years, has always had separate checking accounts as well. I don't know that I necessarily recommend it. I think if it makes operational sense and streamlines some of your operational processes around, like, I don't know, cutting checks or having checks signed or whatever like that, then sure, I think it can make sense. But from an accounting perspective, I wouldn't say that it's necessarily a best practice or even necessarily recommended. You're already tracking the liability in that tokens payable account, right? So that is the actual amount that you owe and could potentially have to pay out in token checks. And there's not really a need to also separate out the asset into a separate account, I think. And then also it means, like, sometimes there will be, if you do have other activity going on the checking account, it's not even going to necessarily match exactly the liability. Like, you're going to have merchant service fees taken out of the account, right? And then potentially you'll have, like, for some markets, like, they get double up payments in their bank account from Farmers Market Fund, and then they also get a growth grant from Farmers Market Fund, and it goes to the same bank account. So then they go, oh, well, now we got to move it over from one bank account to another. So sometimes it ends up just being a little more of a hassle to have to constantly, like, make sure that two separate accounts have enough cash. So overall, my recommendation would be there's no real need to have more than one checking account unless it actually solves some operational problem for the organization. And yeah, Linnea is saying in the chat, it would be cool to see a webinar in the future for bookkeeping for restricted grants of the type just discussed. Yeah, I know I've definitely seen also NAO, Nonprofit Association of Oregon, has done webinars on that topic. But yeah, I mean, it's a big topic that, many nonprofits have to deal with, and can definitely, result in a lot of complexities.
Well, OFMA would love to have you back sometime, Aria. Maybe we can do other topics in bookkeeping too. Mallory, I was wondering, maybe we could bring you on. I know I had some questions come into me before the webinar from markets asking about some of the at-market procedures of best practice for collecting tokens from vendors and doing the reimbursements to vendors. I was wondering if you might have a little bit of time to, first you can say hello and who you are, and what you have seen of what works well for markets.
Yeah, totally. So hi, everybody. For anyone who doesn't know me, I'm Mallory Watson, she, her pronouns, and I am the Farmers Market Program Manager at Farmers Market Fund. So I've seen, there's kind of like two ways that I see markets doing token reimbursement. I mean, there's like some variances in them, but it's either like at market, they'll collect the tokens at market, count, tally up what each vendor has, and then write them a check there or pay them cash at the market. The other way that I see a lot of markets doing it is they'll have like individual token bags for each vendor, and those get passed back and forth between the vendor and the market management each week. So the vendor turns in their tokens at the end of the day. The market manager, market staff takes all the bags home, counts up all the tokens. Usually there's like a slip in there that they have the vendor fill out. So they'll be like double checking the counts. And then they do all the accounting and whatnot at home, enter all the numbers in that they need to enter in, and bring a check to the vendor at the next market. I think, a lot of smaller markets will do at market reimbursement, and it's not a big deal because there aren't that many vendors and it's like quiet enough that it works out. But I think for any larger market or market that's doing like a good amount of SNAP and double up food bucks, I would definitely recommend taking those home and counting them at home. But yeah, that's kind of what I've seen. Does that answer the question, Amanda?
Yeah, that's really helpful. Oh, Linnea, I see your hand up.
Yeah, I just wanted to add, because we changed this year. The past management at the market had been counting tokens day off and cutting checks day off. And I decided to change that when I took over the job this year. And I just wanted to throw it in if anybody is curious, because I kind of expected a lot of my vendors would be disappointed in that change because they would be receiving their checks a week later. But actually, everybody has been very positive about the change. It's putting less pressure on them to count right at the market, and they're getting correct counts every week. So just if anybody has considered changing and is worried that vendors wouldn't like it, I was very positively surprised by how our vendors took that change.
Thanks, Linnea. That's really helpful to hear that. Another thing that is helpful to know too is I would suggest, if you're going to do that, is to try to get your vendor payments on ACH, or so that you don't actually have to give paper checks to your vendors and wait for them to cash them. Especially if you have a lot of vendors. I have heard market managers complaining about, how do I get my vendors to actually cash their checks? They're waiting so long, I'm having to rewrite them new ones. So if you're able to set up ACH payment, then you don't have to deal with hounding your vendors to accept their reimbursements. And then one other question for Ari and Mallory on this: for doing the reimbursements, is there best practice about whether or not stall fees can be incorporated into these reimbursement processes for food assistance programs?
Yeah. So, I mean, stall fees being incorporated into it, you mean like having vendors pay stall fees with tokens.
Yeah, sometimes, yeah, they seem to combine the two
Right, yeah,
processes
yeah.
together and paying with tokens, yeah.
Yeah, it is possible. I don't know if I necessarily recommend it, because, you know, you just have to make sure you're tracking those tokens separately, make sure you know exactly how much was collected in tokens, from the vendors for stall fees, and then make sure and then you basically have to adjust when you recognize the stall fee revenue from that. You're not going to have enough cash and checks. That's not actually going to match, you know, the what you're recognizing as what was paid. So you then have to reduce the vendor's token liability, right, to kind of balance out that difference. So like I said, you can do it, it is possible. Yeah, but again, because of those complexities, I don't know if I'd recommend it. And definitely if you are doing it, I would say to only use cash tokens, or only accept rather cash tokens, and not accept snap tokens. For one thing, I think Farmers Market Fund requires markets to report how much snap was redeemed to each vendor for the year, and that goes into their grant reporting. So, you know, obviously if you're accepting snap tokens as payment, you wouldn't be able to do that. Also, I think there may be legal complexities around that. I'm not sure, but I would definitely say to be safe, if you are accepting vendor tokens for payment, to only use cash tokens.
Yeah, I agree. I don't recommend it. And Farmers Market Fund, for Double Up Food Bucks at least, and Produce Match, it's not allowed to accept those as booth fee payment. And then yeah, we also just don't recommend accepting SNAP tokens for booth fee payment either, for the reasons that Ari mentioned.
Yeah. Well, I mean, Hollywood Farmers Market, it does allow vendors to pay with cash tokens, and, you know, just has a system that works for us, that you know, we can you know, account for everything properly. But yeah, I don't know if I necessarily recommend it for other markets. Sorry if your vendors are asking to do it because they do it at Hollywood.
Yeah, and Lacey and Michelle are saying in the chat that it has been a nightmare doing it that way. I don't know if either of you wants to tell a story about that, just to help get that across.
Cautionary tale.
We just haven't ever allowed it, because I can see, like, it doesn't take a rocket scientist to see that that's just going to be so complicated and messy, and, you know, we're bare bones anyway. I was just like, no, sorry, can't do it. They're grant funding, it's separate streams, you know, can't mix them. I can invoice you on Square if you don't have cash. Like,
And I think also in the chat, there was a little bit of a discussion about how often to do reimbursements, with markets doing weekly, bi-weekly, and monthly. You probably don't want to go longer than a month, though.
Yeah, and I'll also just jump in here really quick to say that you're required in your Double Up Food Bucks contract to reimburse your vendors at least once a month. And then we recommend that you just do your SNAP payments at the same time.
Curious if anybody who does the system where vendors turn in their tokens and then get reimbursed later, if anybody's having trouble getting your vendors to turn in their tokens every week, or vendors hoarding tokens for months, and if you have rules about making that required to turn them in, and how you get them to turn it in. Maybe that's a thing that used to happen that doesn't happen quite as much anymore now that vendors can take credit cards. Lacey's saying, when we implemented the bag system last year, thanks to having the growth grant to help them make that change, the redemption rate went way up. And Melody says we do every other week, but some vendors want to hold them and get a monthly check, just making it hard for her to track.
Yeah, I imagine that would be hard. Maybe you could do the every other week checks and just give 2 of them at a time to those vendors. That might actually be easier. I don't know, but yeah, I can imagine that would be aggravating.
I don't know if there's anybody on this call who does it, but I know of some markets who also like, oh, it's a lot of smaller markets will do like once you have like $50 worth of tokens, then turn it in and we'll write you a check. So yeah, for what that's worth. That also does seem like it could be a little bit like it's a lot to keep track of if you're waiting until each vendor is at $50. Oh, okay, Jess does it.
Mhm.
Yeah, is it hard to keep track of, Jess?
Sorry about that. It can be, especially for folks that get like 3 snap tokens at a time. So they have all these rows of small amounts till they get to the 50. But there are also folks that don't want to do ACH. So it works out okay versus writing checks for $3 or $5 and, super small amounts. But it's a little bit of a hassle, but I kind of still like it because it's just 50 at once and it alleviates extra work in the long run for me.
So Linnea has a question. It's a little bit outside the bookkeeping topic we're on today of focusing on food assistance programs, but I guess we could take a minute to talk about if people want to talk about how often. Okay, so their question is, I'd love to hear best practices for invoicing for booth fees. Do markets do it monthly or weekly? And are vendors actually making the payments regularly, or do you need to hound them to pay? If people want to put in the chat, if you're doing it weekly or monthly, that would be helpful for Linnea to hear. Any other questions about food assistance programs and the bookkeeping for those? And don't forget, if you want to get a 1-hour session with Ari, all you have to do is email him and set up a time.
I think we're saying, basically the focus should be on kind of these sort of areas, SNAP, double up food bucks, incentives programs. We can stray a little bit if you have like other kind of ancillary questions, but basically that's what we're offering these consultations for. And I think we're saying by the end of November.
Right, yes, by the end of November. It looks like we've covered things. Questions have slowed down. Thank you so much, Ari. This was really helpful. I'm really glad to have this recording and being able to show it to people later when they ask me questions about this. And thank you also, Mallory, for being here and representing Farmers Market Fund and sharing best practices that markets do at market. Thanks, everybody. So good to see you all.
See you all. Bye.
Thanks, everyone.
Thanks.